Good evening, most respected faculty of the first session, Adjudication Ramesh sir, and the second faculty will shortly join with us, and all the attendants, those other members of the profession. My dear friends, today we are having a very important session regarding that practical case related to compounding and ED enforcement directives matters, appeals and adjudication, and practical issue in FEMA compliance. Generally, I don't know how many chartered accounts are specializing or doing in FEMA. Doing FEMA. Recent days, there are so many cases are coming daily basis. Around 1 week before we heard that in Chennai also, some of the assets has been seized by ED from a private limited company, around 194 crores. And many places now enforcement directors are making or doing various seizing various assets and arresting so many persons due to non-compliance of the FEMA regulations and rules. So the importance of understanding FEMA rules and how to become relevant on this special timing, as also the government is also very much keen to take all these kind of black money transactions and foreign money transactions. So we hope that this today's session will be very much important for all of us chartered accountants, especially those who are specializing or practicing in FEMA regulation, how to deal with these type of issue before the appeals and adjudicating area, and how we can approach the enforcement directives matters. Fortunately, we have an experts group of persons here for giving us an overview and giving a detailed presentation regarding the practical aspects of all these matters. Now our first session is going to be handled by Advocate Ramesh sir. I am extremely privileged to introduce him for you. He is a practicing chartered accountant for 7 years. Evans became interested in law and graduated as a Bachelor of Law in 1994 and in law practice since then. He is in a negotiation with overseas law firms, completed 2 acquisitions in UK and an assignment of legal advice to a client in Copenhagen. Advisor to the NRI service portal for the Hindu business line. Advising several companies, joint ventures and MNCs set up in India. His specializations are foreign exchange law, investment in India, foreign collaboration and joint ventures, arbitration, business contract, acquisition and so on. He along with his associate collaborates for High Court and Supreme Court, work with the Land Senior Council as well as in respect of litigation matters. As a team, he handled a number of corporate, domestic and multinational company firms in Tamil Nadu. As a faculty, he working as a guest faculty in Institute of Company Secretary, Bharatidasan Institute of Management, and guest faculty in University of Madras, IIT, NALSA, Ernst & Young, PwC, Society, PwC Academy, Society of Auditors, Small Business School, and other various colleges in the city. He participated in several regional national seminars and author of various articles in professional journals, contributed about 170 articles in Business Line. And his other area of interest, he is a good Pradangist and a good journalist with a vast but a short profile of our beloved CAK Ramesh sir. I, with proud, I present before you the faculty of the first session, practical case related to compounding and legal matters of case and adjudication. Sir, I welcome you for this our first session on this important topic, especially those who are specializing in FEMA. Everybody is keen to hear from you, sir. Thank you.
Thank you, Mr. Satheesan, for kind words of introduction. And friends, I hope my video is clear, my audio is clear, so I can start the program straight away. Is it clear, sir?
Yes, sir. Yes,
okay.
Sir, please.
Okay. Now I am going to open up the PowerPoint slide very soon. But before that, let me give you the structure of what I am going to handle. For about an hour or so, hour and 10 minutes or so, I will be handling very practical aspects of what are the legality, what are the procedures, what is the process, what is the best way to defend your client through PowerPoint presentation. By around 6:15, 6:20 or so, I will stop my end program, and thereafter the floor is open for any clarification. So that's going to be the presentation. Now I am going to open up the PowerPoint slide to see whether are you able to see the screen.
Cool, sir. You can continue. You can put it in slideshow and then. Yes, sir.
Is the screen clear now?
Yes, sir. Please. Correct. Clear, sir. Clear.
Okay, I will go ahead. So the practical aspects. So when I say the practical aspect, there are certain things that you should know from the beginning. In FEMA, what leads to any dispute resolution, controversy? There are certain fundamental things, because on some other day we will have a program how there are many certifications that as a chartered accountant you are supposed to validate. All these procedural aspects where chartered accountant is involved depends upon the classification of the transaction and the nature of transaction. Only from here comes the compliance and also the non-compliance. As also, for non-compliance can be resolved either through compounding or through regular adjudication. So the first basic thing, essential thing that one needs to know is classification of transaction. When I say classification of transaction, there are two types of transactions: capital account transaction and current account transaction. Now, FERA, the old law in 1990, as part of the economic reforms, they started the new law FEMA, Foreign Exchange Management Act. To give you a glimpse of a classification of transaction, why is it relevant? The old law FERA was controlling all transactions, current account transaction, capital account transaction, without any distinction. Stated other way, it controlled $100, $100,000, $1 million, and even more uniformly, without any distinction at all. Whereas under FEMA, they have divided the transaction into two parts: a fewer transaction which involve large value, long-term aspect investments called capital, more number of transactions of smaller value called current. I mean, to loosely put it in chartered accountant language, because we know there is a profit and loss account, we know there is a balance sheet. It's not a 100% comparison, but a loose comparison. Generally, current account transaction or yearly transaction, repeat transaction like raw material, purchase of consumables, salaries, rents, so on and so forth, which are contained in or sales, income, trade, etc., which come appear in the debit or credit side of the profit. Generally, balance sheet, especially the top side, consists of long-term liabilities, long-term assets, which are capital account transactions. Now, this distinction is very, very important. More about that I will tell you, because this is not a FEMA class, this is on one aspect of adjudication. Then we will have to see there are two ways of dividing the transaction. Not exactly divided legally by definition, but this is how the authorities approach. One is called non-compliance procedural lapse. Another is called serious infraction or contravention. For example, hawala, money laundering, anything against national security, all these three things normally come with multiple laws violation. It is not only FEMA, but also primarily there is a crime involved, there is a corruption involved, or there is an income tax violation involved, or there is the over invoicing, under invoicing, customs and exports involved, or there could be a violation of some other law or against national security. So they will also involve foreign exchange. Therefore, enforcement directorate involvement. So first, the distinction of the transaction into current and capital mode, and also the procedural lapse versus serious lapses. These two are very important to the point. Then the next one. What are the various sections that gets involved? If there is any resolution, there is a levy of penalty through compounding. Normally, compounding penalty can be levied not exceeding 3 times of the amount. The amount involved, let's say, is $100,000. The maximum penalty that can be levied is $300,000. So the law prescribes the maximum penalty. Maximum penalty need not mean always they will levy the maximum, but they will. Once you are going through voluntary compounding, they will levy a far less penalty. And then there is a section 15. 15 talks about compounding. Compounding can be done by both authorities. RBI as an administrative authority, Enforcement Directorate as an enforcement authority. RBI has got administrative power. ED has got judicial powers. The distinction I will tell you as we progress or during the questioning session. Administrative authorities, it's a very informal proceeding, and they have only certain powers. They do not have judicial powers, like in terms of summoning, or in terms of questioning, or in terms of looking beyond the company, lifting the corporate veil. These are all the judicial powers. ED is a very high-powered specialized body. You have police officers, you have former excise people, you have customs people, you have foreign exchange specialists, and you have money laundering people. All those authorities will be there, and they have different authority. They can pick up somebody from income tax also for special investigation. They can form a special board by notification, or regular officers can do. It's a multi-speciality, multi-law, high-powered, judicial-powered authority. Whereas RBI doesn't have those expertise. They may be experts in FEMA, but and then that too only a summary proceeding. What is the technical difference between these two? I will tell you as we move on. The next is section 17 to 19. 17 deal with the regular adjudication. In adjudication, 18 and 19, you have 3 levels. Adjudication can be done by a lower level authority called ADA or DDA. ADA stands for Assistant Director of Enforcement. Sorry, rather it should be ADE. And DDA stands for Deputy Director Authority or Deputy Directorate of Enforcement. Then, I mean, that normally that is fixed based on like what you have in income tax. There will be some assessing officer, or there will be assistant commissioner, then deputy commissioner, then commissioner, etc. If it is a value, very low value, few lakhs involved in violation, normally ADE or DDE will handle the matter. Then you have special director appeals. It's a higher level authority. The special director appeals, only thing you have to note is, although the word appeals is used, normally lower level authority, they also hear appeals. But it need not necessarily mean they will hear only appeals. Sometimes large value. Recently we appeared for a matter. There are more than 37 lawyers appearing for the same case. And that involve multi-hundred crores. So those are the things directly special director will hear the matter. Then we have a foreign exchange appellate tribunal. Then along with that, you must read the adjudication proceedings and appeal rules, which contains what form. For example, form 1 has to be filed for appeals. Form 2 must be filed for tribunal appeals. Then how the order copy must be enclosed, how much certificate copy must be there, what are the fee involved, how filings, pre-deposit of penalty, what is a statement. Just as you have income tax tribunal, there are elaborate procedures prescribed. I don't want to go into the procedures, but normally once an adjudicating authority gets involved in a matter, for example, I am talking about adjudication means regular adjudication. I am not talking about compounding. I will talk about compounding finally, because compounding is relatively now it is settled. Anybody can appear before Reserve Bank of India. It's a voluntary compounding or it's a compounding based on a memo issued by Reserve Bank of India. You have to file what is called form 1 according to the compounding rule, pay 5,000 rupees fee, make a petition of defense and the violation notified. Then they will fix up a date, they will call you in a nice sofa, air conditioned room, offer you tea, and they will hear you, take a lenient to levy a penalty, pay the penalty, everything is blessed. All offences are regularized. There is no question of detailed inquiry, deposition, and in compounding before RBI authority, you have to accept the guilt, which means you will not state a position which is against the position of Reserve Bank of India. Both of you will agree on that there is a violation. So that happens for a simple procedural lapse, not for heinous offences. Sometimes ED also will take up. I will tell you the distinction how compounding can be done by ED, how compounding done by RBI. RBI has limited powers, summary proceeding, non-judicial but administrative powers. Whereas ED has got a wider power. Some cases which are not taken up by RBI is also given to ED. Now, talking about enforcement directive. First, what are the various? There are 4, 5, 6 stages before which the process happens. First, the deposition. The deposition means they will call the person who is a contributor. Let's take an example. For example, there is a X private limited, there is a company, and there is a managing director or any director who is in charge of the business or the company on a day-to-day basis. So the first thing what they will do is they will issue a summons saying that there are allegations. You please bring all the documents. Normally, they won't even state what is allegation. They may get the allegation directly from RBI, or they may get some information from Revenue Intelligence, or they may get from any of the department, tax department, or customs department, or some other bank, or some other authority on if it is a money laundering matter, or some other government agencies. So they will summon the relevant person, ask them to bring the annual report, sometimes passports also, and then the list of documents that they see, and then they will make a statement. They have some information. They will ask you to make a statement and then prepare all the needed document as a supporting document. Now, the point we have to note here is the position, although I say it is a part of the proceeding and then I make it in a PowerPoint sheet for presentation. In deposition, normally a lawyer or any professional is not allowed. You can't go and tell them how you have to conduct in deposition because you don't know. You can't even prompt from beginning. Maybe you can give a support based on what has happened in the proceeding. Beyond that, you are not allowed. And then they will record the statement. Just as the evidence rebut under section 37 with 131 of the Income Tax Act, they will record all the statement. And then for the recording of the statement, they will also record what is the admission, what is the non-admitted part, contested part. And then they will go on to build up a case to prepare. I mean, as you are aware, you can't make out a case against anybody based on their own what they depose. That may be out of fear, that may be out of some harassment, that may be out of because they are scared about the very department. So once they do that, they will frame up case and then they will have a relied upon documents. In order to prove the case or a violation, what are the documents you are relying upon? Then internally what happened? One of the officers prepare a complaint, something like a charge sheet externally in criminal. The complaint does not mean there will be a show cause notice. In fact, relied upon documents and deposition, the first two bullet does not mean it will necessarily fall into complaint. Sometimes they will ask deposition, they may say it's a very the information they got is not corroborated and the deposition is cogent, it is backed up by full record and there is no violation, they may drop the case also. But let us say there are 10 charges, information which has come, 7 or 8 they may drop, 1 or 2 they may find, okay, there is a violation. So they may request one of the authorities to prepare a complaint. Complaint is what they will detail the entire case, the deposition made, the accepted part, non-accepted part, the documentary evidence, what was dropped and what is made out, and what are the sections, subsections in different laws where there is an alleged violation. Once a complaint is made, it goes to an authority within the department, and they will say it is a fit case for further proceeding and levy a penalty or prosecuting the person. They will issue what is called SCN, show cause notice. It is Show cause notice is something common for all of them. It's the same show cause notice. After the show cause notice, they will fix up a date. They will say, the allegations have come that these are all the things, whereas you have been deposed on so and so matter. A complaint was formed. Based on the complaint, we are issuing the present show cause notice. And once they issue the show cause notice, there will be a hearing and there will be an order. The point that you have to note here legally, technically, practically speaking, a deposition need not mean there is a making of case. Sometimes they will ask you to depose, and if they find there is nothing at all, they may drop the case. Relied upon document, they have to prepare cogently to back up the charge. Once the deposition and relied upon document, it goes to the third stage of complaint formation. Once there is a complaint, it goes to the stage of show cause notice. Once that is a show cause notice, it is not necessary that every allegation in the show cause notice will be proved. Because show cause notice only says show cause why you should not be penalized. Then it is open for the professional to defend that. At that stage of show cause notice, a professional can enter. You can file a representation as a chartered accountant, or you can file a wakalatnama if you are an advocate. Then the notice will come to you. You can say these sections are not applicable. There are technical defects. Parties arrayed in the show cause notice are proper, not the proper parties. And the allegations contained in the different law are only allegation baseless, not backed up by document. Even if there is a document, the document is not cannot be relied upon because of these reasons. And I can introduce fresh evidence to say how I have complied with the law, why there is no violation. And the particular section what you are saying on the merits of the section is not applicable to me. Like that, you can go on to build up any number of defenses. That really you can't generalize it. It depends upon the merits of the case. Then there will be a date fixed for call notice come for hearing, where you can make out your case. Then there will be an order. When it comes to appeal, special director, while this is a common procedure for lower level authorities, in appeal there will be an enforcement director person also. Somebody from a deputy director, they will make an allegation against you. You can argue against them. Then there will be an order. Order can be levy of penalty. The penalty is normally in FEMA case, because we are more concerned about the FEMA case. I appear only for FEMA case, not where there is a money laundering involvement or against national security or some other law infraction. Once there is a FEMA case involved, then you can say quote several sections. If it is a capital account, there are a number of capital account regulations. For example, FDI, you have ODA, you have guarantees, you have ECB. And if it is a current account transaction, there are a number of transactions. God knows how many transactions with the export or import, no over impulsive. And there is, you can say, country specific situation, pandemic situation. Like recently, what 2 years we had is a pandemic situation. It's an extraordinary situation where monies cannot be received. There could be many differences based on facts, based on value, based on shipping document, based on country specific, buyer specific, based on your reasonable contact, and so on and so forth. All those things you can take it up at the time of hearing, and they will consider all your presentation and the counter defense statement and the document that you produce, and compare it with whatever the department says and pass an order. Then, best evidence to be produced with a clear drafting as defense against all allegations individually. See, when I say individually, I mean not only, let us say there are 7 allegations of different sections, and there is a company and there is a managing director personally involved. All these allegations you must meet out for the company and also for the managing director, because there will be no TC1 will be the company, no TC2 will be the director. I mean, I'm saying 2. It could be many. If it is a large company, a company secretary may be involved, a CFO may be involved. Then you can say some are involved in some transactions, some are exonerated according to the board resolution in some other transaction. You can say as a director, you are so and so is responsible for this area. So when I say all allegation individually means I say individually against each of the notices. As I told you in the recent case where we appeared, there are as many as 37 notices and there are 37 lawyers. Sometimes it may so happen one lawyer will be arguing against another lawyer. One will try to exonerate himself. So those are the things you have to make against individual. Then there is something called section 42, offense against company, liability of directors and officers in charge. See, normally if it is an individual or a proprietary concern or a partnership, they would not go with the firm, they will go with the partners, especially when there is a managing. But if it is a limited company, as you know, not only company is a separate occupational legal person. And apart from the company is handled by the board of directors. In a private company or a public company unlisted, there will be specific duty on a director. If there are no managing director or the whole-time director, all directors will be charged. If there is a managing director, normally, typically small company, husband and wife company, brothers company, one will be a managing director. Another will be involved in production aspect. A person in charge of production or manufacturing, unless there is a GST or excise or some other tax involved, he may not be involved in the administrative matter, compliance, non-compliance, etc. So in those situations, the director in charge must be fixed. But normally what happens? They will send a notice to all the directors. And if there is a company secretary or a chartered accountant, they will send the notice to them also. And these days, a trend is starting where I have to alert you, when there is a chartered accountant or a special company secretary certificates involved. Not in all matters, but in certain matters, they will issue notice to them to justify their professional position. So your working papers to understand whether it is a capital account transaction or a current account transaction, the nature of certificate. A certificate is different from opinion. You can give an opinion just as a lawyer gives an opinion. Opinion can be right, opinion can be wrong. Because you say opinion is a very strong word. But the moment you say a certificate, for example, a value of a transaction, capital account transaction, normally Reserve Bank of India gives certain valuation guidelines. There you certify that this is a value. Then it comes to the accountant's domain. Balance sheet, profit and loss account at a particular point in time. So those are all the matter. Offense against company, liability of directors and officers in charge. Sometimes they need not be directors. It can be key managerial person. For example, if it is a listed company, normally for everything the managing director may not be there. There will be special whole-time directors involved for finance, or a CFO has been delegated power. A company secretary may issue every board meeting compliance certificate, therefore he may be involved. The external company secretary may be giving certain certifications, they may be involved. Or if there is an export, particular chartered accountant will be involved for an export realization and department by the board resolution. And so only those will be involved. And if it is a private company, for example, there are directors, other directors who are only a public unlisted company, independent directors, or non-executive directors who come once in a 3 months for a board meeting on an advisory position based on the special experience, qualifications, etc. Now, in those matters, they will not be charged for because they are not in charge of or responsible for the conduct of the business. The word used to have two things. Whenever an offense is committed by a company, the company and every other officer in charge of or responsible to the conduct of the business of the company. So you have to be in charge, you have to be responsible. Sometimes you may be in charge just for board resolution purpose, but you may not be responsible factually because those are the days you may be absent. For example, there was a case where a private limited company was charged. A managing director was responsible for certain things. There was other directors, certain other departments were given. But the managing director fell sick for some major surgery and he was out of office nearly for 4.5 months. During that period, best part of the violation took place. So he took a defense, giving all the medical reports, admission, surgery, etc. I was completely out of office. I was not attending to the office work. Therefore, although theoretically I am in charge, in practical term I am not responsible because I never took the decision. But I gave the mandate of signing to some other director as a joint signatory so that operations do not suffer. So those are the matters in charge of and responsible to the conduct of the business of the company and every other officer, not only director, CFO, company secretary or any other officer or person to be specifically made in charge. Even if it is not made in charge, he was actually doing the transaction. So those are the technical matters involved. Then what happened? There is also something called LSF. Recently it has come, although it is not part of adjudication. This is a method to avoid adjudication. LSF is called late submission fee. This happens after November 7, 2017. This is for non-filing, mostly for procedural lapses. So there is no great legality here. Suppose some form has to be filed, let's say within 30 days, 40 days under the law. You go and approach your file. Now it's all digital, e-business platform, forms, etc. So you file not within 50 days or 40 days within the legal prescription. Let's say there is a 100-day delay. There is a late submission fee. Automatically it is calculated, and it once you fill up all the column, file the form, it will upload it once you pay the fee. So I'm not taking it is meant for some other session. The LSF is not part of this. Now these are the legalities. So I will quickly recapitulate whatever that I have told you, and then go and involve, because the title is practical aspects. So I thought I will give you a few instances to drive home the same point. The first point is, whenever a violation comes, the violation could be a compounding. A violation could be an adjudication. Now, before I start going into the individual details of cases like private sector banking, private company, etc., I will give you the differences of what do you mean by compounding and why the compounding is done by two authorities. One is Reserve Bank of India, another is Enforcement Directorate. And what are the differences between the two agencies? This is essential. Now, compounding, as you know, you enter into a settlement with the regulator. In fact, the regulator doesn't want you to go to adjudication authority, because adjudication is a very harsh procedure. And whether you like it or you don't, even for a FEMA matter, nobody likes to go before enforcement director, because they are trained in a particular way. And even a routine matter, they will go by their own, like reposition, building up of the document, complaint, show cause notice, hearing order. That cannot be dispensed with. Whereas with Reserve Bank of India, people, they are very administrative people like you and me. They are officers. Maybe they are higher level officers, like your compounding authority, general manager, etc. You will be comfortable going to the office, and they will offer you very comfortably. You discuss your case, and they will take a. There won't be any harsh statement or somebody will be negative your point. Because in compounding, you accept before RBI, you accept the case. It's an optional procedure. You can accept. RBI will always give you the option of going through compounding. It will not compel you. You can accept or you need not accept. If you don't accept, they may refer the matter to enforcement. So, but mostly people accept. So RBI is, for example, in the company situation, the last slide, what I told you, I will just go back to the last slide, section 42. RBI will levy only compounding on the company. It won't go beyond the company to director or officer, because that will be, those are all judicial powers. RBI says if the company has to file, let us say, there is a form called form FCGPR. The moment you issue shares, within 30 days, you are supposed to file. You don't file, you file bilaterally. Now you can go through LSF. Suppose you have to file some other form ODI, or there is a export non-realization. You file an uploading for compounding. RBI will understand, yes, there is a contravention. Then they will go on to find out what is the extent of contravention. Because once that is an amount involved, only then it can be compounded. When there is no quantifiable offense, there cannot be a compounding, because the penalty is based on the amount involved and the time of delay. RBI says, okay, let's say the amount involved in violation is, let's say, 2 crores, and the delay, let's say, is about a year. Then they will levy a nominal 2 lakhs, 3 lakhs. Once you pay the penalty, automatically the entire thing under relevant section quoted, charged you, or completely regularized. Then you are exonerated from all the liabilities on the same section, on the same matter, future. RBI will not have power to go through section 42, see who the officers are, who was responsible for that day, whether they can be penalized for non-compliance, etc. So, compounding is a voluntary process with Reserve Bank of India with a limited powers. It's a summary proceedings. It's a quantifiable offense. It's an optional proceeding where you accept and go through the transaction. Whereas compounding penalty can also be levied by ED in the proceeding, but that will be a different proceeding. They will go against the company, they will go against the persons behind it, they will go against all other law. For example, if there is an income tax violation, a PMLA, Prevention of Money Laundering Act violation, or an excise or customs violation, or some other criminal law process getting involved in FEMA in Hawala transaction. ED will have multiple functionaries to go through all of them. They can seize the property. They can take the jewels. They can conduct a search. They can confiscate. They can go beyond the company. They can go through multiple laws. Reserve Bank of India has no such power. They can't search. They can't confiscate. They can't go beyond FEMA. Even in FEMA, they can't go beyond the company to officers. But they don't have expertise. They don't have judicial. So this is the important distinction. Now, some examples of, I told you the process. The process is deposition, then collecting relied upon documents, and then building up a case, then cogently building up the evidences involved, raising a complaint, then formally issue a show cause notice, fixing and then enabling you to file the reply with your own evidences, maybe additional reply at the time of hearing, and then representation or personal appearances, then argument, then order. This step-by-step procedure is what we are. A few examples I thought I will discuss practically what private sector, because these are all the cases which some of the cases we have appeared. I am not for mentioning the names of the company or person who is involved. I am just generally telling you how the cases are done, what is the enormity of it, how we have to build the defense, what are the niceties for us. Private sector bank. Suppose shares are purchased. You know, certain sectors in FDI, now today most of it are 100% made free for foreign direct investment. But are some sectors like insurance, banking sector, etc., are jealously guarded because they are all very volatile industry of strategic importance. Like the private sector banking, if there is a foreign investment, let's say the cap is 49%. Nobody can acquire the shares of a private sector banking unless you get Reserve Bank of India prior permission from the banking side. There are two aspects of Reserve. Reserve Bank has many departments, non-banking, finance department, then Department of Banking Regulation. Of course, we have foreign exchange department, you have export department, so many things. So, apart from complying with FEMA regulation, you need to comply with banking department license and the investment in shares, who is investing, etc. You have to get a prior approval from central office because they monitor it for some other interest. Supposing there was a company, a few individuals who wanted to acquire shares in a private company, let's say XYZ. They obtained Reserve Bank of India prior permission. But when they came to invest in a company, they formed in Mauritius their own 100%, that is only one. I will explain it. X formed a company called X Company Private Limited in Mauritius. 100% of the shares are held by him, 99% and 1% by his wife. Similarly, Y formed a company, Y Private Limited. Z formed the company, Z Private Limited. But the approval was obtained by individual. Once they start investing in a company, company also said they got approval. There is a technical problem. Instead of their investing individually, they have invested to the company form. And the company is 100% held by them. So company and them are one and the same. And they passed a board resolution. They informed Reserve Bank of India immediately. But then later on, it became a big issue because two groups of shareholders were fighting. Any industry, if there is a fight internally in the board, they are divided. The business will suffer, shareholders will suffer, wealth creation will suffer. More so in the banking industry, where secrecy, confidentiality are very important. Now, the allegation of the opponent shareholders are that you are not backed up by an approval in the name of the company. True that you have got an approval in the individual name, but you don't have a company because RBI may consider an applicant as an individual. Individual has to sell the shares to another person. At that time, there is a checks and balances. Whereas, if the shares are held by a company, company need not transfer the shares. Company can continue to hold the shares. The shareholders of the company can sell the shares to somebody else. This makes a lot of difference. It's not a technical. RBI at any point of time would like to know what is a foreign interest in a private sector banking. You are defeating the very purpose by forming a company, obtaining. In fact, if you want to invest, you could have gone back to RBI say that I want the amendment of the approval in the favor of company, which is not done. And the bank board has also committed a default, a contravention, by accepting the individual approval as it is a company approval. So that is a case. So the case went on, the enforcement directorate conducted the whole thing. The other thing here in this case is they issued a show cause notice, levied a huge penalty of the order, because the investment was running to hundreds of crores. They levied penalty of 10 crore, 15 crore, and they further said, you cannot make further investment, you cannot transfer the shares, the borrower shares also will be subject to proceedings, and you cannot get dividend, it has to be put in a separate, all economic interests of that. Well, there are special reasons. I don't want to go into those reasons for that company. Then there are multiple writs in the High Court challenging the order. Some appeal was filed. Somebody, one opponent shareholder wanted to take all the shares. They said no share voting rights should be given. So all those matters went in all kinds of circles all over India. So there, as many as 30-35 lawyers were involved in arguing, and some interests were opposing between not only ED, between one group to another group. So these are all the complex matters where hearing may go on for about 6 months, 1 year, even if it is continuous. The order can be of the order of hundreds and thousands of pages. So this is an extreme complex cases where banking matter is involved, Reserve Bank of India Act will be involved, FEMA will be involved. But fortunately, in that case, the investment was above board. It was not by any hawala or any other transaction. Those were in strict compliance. Then another case I will tell you, where a private company removed from the register. This will tell you how compounding is done by RBI can be frustrated because of certain things. I will tell you the case where normally you as a chartered accountant will know. Take a situation, X company private. The company received a certain share application. Let's say 1 crore of share application. And you know, the moment you receive share application money, you are supposed to get FIRC. FIRC stands for Foreign Inward Remittance Certificate. The FIRC is normally obtained from banker, and you have to file the advance reporting, what is called. Bank nowadays it is all digital. But at the time when the violation started for this company about a decade before, it was physical. You have to give an advance intimation. No particular form is there. Those days there was a covering letter. Basically, you say who is the investor, which country it belongs to, what is the name of the person, how much money is investing, which Indian company is investing, for what purpose, equity or whatever. And then basic details. I'll give a copy of the FIRC certified by the bank. Once you do that, advance reporting is completed within 30 days. Thereafter, when you issue the shares, you are supposed to issue. Now it is 60 days. In companies at 56, about 2008 or 11 matter I am talking, there at the time it was 180 days. You are supposed to issue the shares. Once you issue the shares, within 30 days, you are supposed to file form FCGP. So there is an advance reporting when the money is received. There is a reporting within 30 days after issue of shares. In between, you are given 180 days. Now, what had happened in that case is, the company did not have business. And they were all held by one of the foreign director was there, another local director was there. Suddenly the foreign directors, which had some other interest in other companies here, those business were lost and they went away. And this company was hanging. There was no transaction. And there was no return which was filed. Then ROC issued a notice saying, you are not filed any return for last 2-3 years. Please come and file and regularize the whole thing. If you are not filing the return, we will be striking the name of the company from the register. Meanwhile, the share application money was continued to be held as a share application money. And the bank account became inoperative. So bank has started freezing the account. There was no operation. Because one of the signatory foreign director went away from the country. When RBI notice itself was not responded, RBI after 2-3 notices struck the name of the company from the register. At that time, they came back and said, don't strike because we are getting some other licenses. We have to regularize with the Reserve Bank of India. And then they went and pleaded, but NCLT passed an order saying, no, the deletion, because you are not complied with the law, striking the name is we confirm that is in accordance with the law. Then they went to appellate authority. They also confirmed. So the company is virtually evaporated, gone from the list. Meanwhile, these people came to be saying, look, we have got some agencies, company itself is not there. We have to regularize FEMA. How do we go about doing it? I said, you write to the bank. Your bank is there. Bank said, no, the account is inoperative. But you give your representation, details, etc. We will forward it to Reserve Bank of India with our recommendation. So they said they collected all the details for about a month or so, this and that, the date, FIRC copy, who are the original directors and why there was a slip, what was the extent of money involved, etc. Now, Reserve Bank of India normally in these matters will say, okay, there is a delay. So you now either refund the share application money or you issue the shares. Instead, what they said the same letter, issue the shares or refund the share application. Now, this is a peculiar case. Normally, any one of the two must be possible. Normally, investor would like to get the shares, or you can at least belatedly, you can refund the share application money to them, which means there is no share issue, and then you can penalize them for delay in filing share application money, or delay in issuing, refunding the share application. In this case, what had happened, since bank account was frozen, and there was a bank account was in the name of the company itself is not there, and they have used the money in some other business matter, etc. Money is dried up. They cannot refund the share application. Then they asked me, what do we do? Issue the shares. That is the next only option. They cannot issue the shares for the same reason, because there is no company, there is no board, there is no business, there is no bank account. How can you issue shares for a non-existent company? So they said, we can't comply with both the directions. We can't refund the share application money because company itself is not there. Bank account is frozen. There is no money left with the bank account, only few thousands. We don't, the money was used by working capital and lost. And then the other option of issuing shares also is not possible because company is not there in ROC. Now this is a case, Reserve Bank of India will suggest an optional compounding only when the company is there. When the person violating himself is not there, they said they have referred the matter to enforcement directorate. Because these are the very complex. Beyond that, if the company is the violator himself is not there, how do we issue notice, form a complaint, who you will call? RBI has no power to summon, etc. There is a voluntary compounding, come compound, go. If there is no voluntary compounding, RBI will initiate compounding, provided the contravenor must be available legally. If he is also not available because these are the very peculiar cases, enforcement directorate will issue notice to all the foreign director, local director, and they will ask them to come. And these are the matters which can go to. Another case, a private limited company, investment in prohibited sector. Prohibited sector is one, prohibited sector, permitted sector, sectoral cap. These three distinctions are there in FDI regulation. I will not go into all that of FDI regulation, but I will simply say private limited company, investment in prohibited sector. Suppose I say a particular sector investment is prohibited, let's say agricultural sector. In an opinion came to me, which was already opinion was given by two law firms, one in Delhi and one in Bombay. That one of the client of the law firm here, their client wanted to invest about 400 crore in a set of land in South India. We found on verifying the record, those lands were agricultural lands. Then they said, no, we are trying to convert that into regular residential or commercial building by reclassification. So there is no botheration. It is only the investor, foreign investor who formed a company is a violator, not for the buyer. I said, don't go for that. My opinion was different from others. Others said, take a risk and buy it because you are not, you are only a domestic investor. Even though the company which has got FDI has invested in agricultural, you can always buy it, reclassify it, and you can, because you are a domestic investor in rupee, FEMA will not be applicable to you. Therefore, there is no violation insofar as a domestic investor is concerned. I gave the opinion no, because for two reasons. At the time of investment, the company had foreign investment. They are not supposed to go into investing in agricultural land. And they did that. Subsequently, they are trying to reconvert, etc. By classification, etc. is a different matter. But at the time of original investment, they invested in agricultural land, knowing that it is an agriculture. Number one. Number two, when I went through the due diligence, the memorandum and articles of the company, they never had power to invest in agriculture. In fact, their power was to do something at development, construction, etc., which they never did. They kept the land as it is. So, two things emerge out of the power legally given to the company under the memorandum was construction and development, which they never did. They kept it as an open land without classification into residential or commercial land. They continue to keep it as agricultural and trying to reclassify only now at the time of sale or subsequently sale. Number two, they did not have power to invest in agricultural land by FEMA regulation, which they actually invested. So what was prohibited legally, they invested. What is the object for which they stand according to their own charter? They did not pursue. So it is ultra vires, and they did not pursue the object which is against their interest, which is an evidentiary matter. So enforcement directorate may, for all that cease, because it is a prohibited sector. See, I will tell you the distinction between the two. The earlier private sector banking, there was a omission, but they had the approval. The approval was in the individual name. What was lacking was approval was not converted or amended in favor of company which is wholly owned by the individuals who got the approval. In this case, it is a prohibited. That was a permitted sector. This is a prohibited sector. Even if they go for approval, RBI or Government of India by their policy, they do not have power to give approval for what is fundamentally prohibited. So I told them they will seize the asset block, and in the process, your land also will go into it. You will be investing 400 crore, assuming the cost of capital is 9 to 10%. Supposing there is a seizure till the time, and no court will interfere at the time of investigation. There is a deposition, they will collect all the documents, and the company is a very big company. They will get other information from different government agencies, which may take 6 months to 1 year to get. And then there will be a complaint, show cause notice, a hearing, multiple lawyers will appear. By the time they prepare an order, till the time the stay cannot be vacated. So let's say it takes 5 years. What is the cost of capital? Let's say 10 to 11%. And if you convert that into apartments, your business return is more than 15%. So what is the comparative loss, opportunity loss? 15% on 400 crore investment, 400 crore is locked up, which means every year you will lose 60 crore. In 5 years, you will lose 300 crore, 3/4 of the capital will go. And your business will go, all other existing business for want of working capital will be finished. Suppose you borrow and invest, the bankers will start as a creditor. You will become a NPA. And you will be a defaulter in the banks. So either way, you are not supposed to invest. So I gave a very detailed financing, and from the investment perspective, from the FEMA perspective, from the company law articles and memorandum perspective, I gave a detailed opinion. Because fortunately, they did not go through the investment. And some other domestic person who went through the investment, they got into the same problem. They got locked up there because bankers also sometimes omit to see these kind of niceties. So you have to see whether it is a permitted sector or prohibited sector. Permitted sector, practically one approach. Prohibited sector, practically harsher approach. It's even more riskier. Not having the approval, the way it has to be approved under the permitted sector, quote unquote, is a technical omission. Prohibited sector is an outright violation of law, because even if you go for approval, they won't give an approval. Then confiscation and other procedures can happen. Of course, LSF I told you, it applies. Then there are other situations. I will tell you another situation where it can happen. For example, in this case, there is a private limited company. In the private limited company, they wanted to proceed against a director. In fact, the director was a partner in a chartered accountant firm in Singapore. There was a company, there was no division of classification of managing director. There will be X director and Y director. X is a non-resident from Singapore, he is a chartered accountant, partner in a chartered accountant firm. So they issued a notice to the company for a violation, some loan transactions, etc. We told them, we appeared before them. When they wanted to proceed at the second notice, again the chartered accountant in the floor, we produced evidence saying, look, they said they have both of them are directors, therefore they were in charge of and responsible for the conduct of the business. I gave them the counter option. You can't proceed against them like that because my client notice one was a director here. Because the other person is a local director, he should be presumed he was in charge of and responsible for the conduct of the business. Because my client was a partner in a partnership firm, and I produced all the chartered accountancy registration of the partnership firm. As a partner, he was getting a salary there, Singapore. And I raised the defense. When he was a full-time partner, there was nothing on the record to suggest he was a part-time employee. He was a partner. He was a very senior person. He was getting a fat monthly salary as a remuneration for the firm. And he was supposed to practice as a partner full-time in Singapore. Once he can't practice full-time getting a salary in Singapore, on the same count, he cannot be a full-time director in India also. So they accepted that. So the entire proceeding were quashed against the director. Of course, the company was penalized. So these are all the multiple ways by which things can happen. So now the time is going to be 6. In less than 5 minutes, I will quickly recapitulate whatever that has been said. Then the floor is open for any clarification. First, you have to divide the transaction into current and capital. I will also tell you the reason why you have to divide the transaction. Because capital account, there are detailed regulations. In current account, there are no such regulations. Because current account, generally you go to a bank and do it without any ceiling limit, because we have current account convertible. We do not have capital account convertible. In fact, just as you say articles of association in a company, you also have articles of association, international monetary fund. India is a signatory to Article 9, which means what? Once you are signatory to the articles of association of IMF, under forex transaction, even Parliament cannot, as a nation, impose fresh restriction on current account transaction. Even Parliament is barred. Then you have to see, because current account means normally there is no chance of getting violation unless it is a very technical matter. Because the bankers themselves take care of the procedures. Bankers have been given a very detailed operating instruction. For example, I tell you dividend. Dividend is a current account transaction. Share is a capital account transaction. So in dividend means what? Now they will ask for a chartered accountant certificate. How much dividend the company has, the shareholders have approved. How much, what is it, whether dividend distribution tax or shareholder tax has been paid. Evidence for payment of taxes. Once all that is given to them, they will verify the number of shareholding, pro rata nominal value of shares, and the percentage of dividend, and they will remit it. So there is an inbuilt check in, and then these amounts are generally very small. As you know, dividend company share may be valued 100 rupees, 10 rupees share. But the moment you say dividend, dividend is on nominal value of share. It will be a few lakhs. They will remit it. For example, you say salary. There was a case. One of my clients had an expatriate managing director. He was given 5 crore of Indian worth, about 3/4 of a million as salary. So, moment 5 crore, they will say social security, tax paid, TDS certificate, all that is given. They will remit 75% of the salary. There is no problem because there are board resolution, there is an employment letter, there is a charter account certificate for payment of tax. And then these documents they will collect and they will remit it. There is no problem because they are all current account transactions, whether it is dividend or salary or even royalty, for example. There is a technology import. Once you say there is a technological import, they will ask for evidence of proof of technology import. They will ask for chartered account certificate, R&D cess, whatever applicable cess and tax. And there is a particular serial number given by the banker. Once you fill up that, automatically the system is inbuilt that there is no RBI or FEMA as a legal requirement involving current account transaction, except permitting them wholesale. How many transactions you want, you can do whatever action you can. So the distinction into capital account and current, whereas capital account, banks comes into procedure only for certain validation and digital filing and like certificates like FIRC, etc. If you don't file, bank will not compel you to file. They can only refer the matter to RBI. So there is a whole lot of obligation on the professional in terms of certification, in terms of pre-investment procedures, ceiling limit, parameters. For example, I will give another practical example. Ceiling limit. Overseas direct investment. In overseas direct investment and FDI, both are investment. Both are capital account. But FDI is a capital account investment. Overseas direct investment is an economic term. Most of the FEMA follows the economic terms. It means TFC, total financial commitment, which means not only equity plus loan plus guarantee. All of things must be less than 400% of net worth. That is why they ask for a chartered account certificate. Now, these are the obligations outside the bankers. Whether you invested within the saving limit, whether you have invested after forming the company, bank will support for UAN. Whether you got the UAN or without UAN, when you are going sometime when they go abroad, they will give some traveler's check $500 to open a company. That is not that's a violation. Anything other than bank route is a hawala transaction. That is why in FEMA, one general rule: if you divide the transaction into current and capital, and then receive the money through normal banking channel, supported by banking document, accounted for in the books and offer for income tax, 95% of the FEMA cases can be defended. These are the things. Then the next one, I told you section 13, 15, 17 to 19. Read with rules. Levy of penalty, maximum 3 times. Here there is a, I will talk to you about VR Krishna Adjudication. Even though in competition, about 30 years before, I appeared for a matter in a SEBI violation. Those days, SEBI used to levy 5,000 rupees penalty. Like company also, you have compounding. SEBI, some rules you have compounding. FEMA also, you have compounding. Then VR Krishna gave you have in income tax, 1961, unreleased case. In unreleased case, they said, only for contumacious act, there must be intention to violate. Only then penalty can be levied. But that was reversed by VR Krishna. They said there is no contumacious act, intention, mens rea. All these things are not applicable for civil law. If a corporate or any client violates foreign exchange law, because these are all substantive procedures. No need to see intention, because how does RBI say we have today in our reserve 620 billion? All of you file what is current account, capital account, debits, credits, workers' remittance. If you don't file it, and RBI banks through bank will not be able to collect the information. There is a large case of data which is happening in SEBI through participatory note, through direct investment, to portfolio investment, individual investment, NRI, local households. These data are essential economic intelligence which is required for security of the nation. So they say you cannot go into like unreleased case, intention, etc., etc. Once there is a infraction, some compliance has to be done by the law. You are not compliant with, there will be a heavy levy of penalty. And this penalty of $5,000 is gone now. As I tell you, SEBI has started levying lakhs, in some cases even crores. Recently, they levied a corporate, a media company, 25 crores penalty. Similarly, in FEMA, the penalties, although it will not be 300 times, it will be quite substantial, quite heavy. It is not ordinary 5,000 and 10,000. Compounding fee may be 10,000. Suppose there is a case where a 10 crore of foreign investment, there was a procedural lapse, that's all. But they delayed it for 4 or 5 years. So they levied as much as 15 lakhs penalty. The idea is to compel and force you to heavy penalty, not as an exaction of revenue, so that digitally at the same time they will bring e-business platform. They will ensure digital compliances. So it is quite certain, but normally 3 times at all, I have not seen 300 times of penalty. Suppose amount involved is 10 crore, they won't levy 30 crore. I have not seen. Maximum they have gone up to 100 crore, 100 times, which is the entire amount of money. Mostly it will be a part of the amount. Now they have got a formula also for compounding. Compounding can be done by RBI, summary proceeding, ED with the judicial proceeding. I explained you the detail. Assistant Director of Enforcement, Deputy Director of Enforcement, Special Director of Appeal, Appellate Tribunal, then High Court, Single Bench, Double Bench, Supreme Court, it go on and on. But for us, it is adjudication is important, read with the rules. Deposition, relied upon documents, then complaint formation, show cause notice, hearing and order. This is a stage at which it can go. Now, after the show cause notice, professional assistance will come, not before. Deposition, etc. are based on Here I will tell you as a chartered accountant, what is a practical difference you can take. I will tell you the example also. In one case, they have received, you must also know, because these are the practical things. Now in export, then digitally there is one called EPDMS platform, where bankers are supposed to file export data processing. Some digital platform is there. As soon as you receive the money, along with the shipping document, suppose $100 is a shipping document. Later on, you have received $100. They have to file in the digital platform. Okay, $100 for exported, $100 for receipt. It will be reconciled. Now, because of bankers' fault, sometimes they will not update them. You would have received the money in banking statement. They would not have updated. So, based on that experience in a large company, I don't want to name the company, large listed company, suddenly hundreds of crores there was a difference between bank because they changed the bank because of some difference of opinion. So, for 3 years, the bank officers did not update the record. Not because of the fight, but because officers changed, because of their own, it was the reconciliation was not made. Frequently, they have not been interacting. Suddenly, enforcement directorate said, no, you are failed to receive some 300, 200 crores. We want to issue a summons. Now, the practical problem, the company was managed by one of the very good group in India. There is no problem in facing the enforcement directorate or appeal or court, because merit-wise they are very clear. The bad debt for the total foreign investment was less than 1%, which is very normal for everybody. Even RBI allows 5% of the average turnover self-write-off. But the problem is they were awestruck by suddenly the enforcement director coming out saying so much of money not received. Later on, we understood the bankers, because of certain reason, did not do that. Now they went to we approached the two-level basis. Go to the bank, give a chartered accountant certificate verifying all the debts received, not received, what is the bad debt, and then approach for reconciliation. Bank with repeated following, it took nearly 3 to 4 months for the bank to update the entire, because every year the company had more than 5,000 invoices. You can imagine, for 3 years, nearly 10 to 12,000 invoices were there. It took nearly 3 to 4 months to reconcile everything with the bank statement, with the chartered accountant certificate. Elaborate Excel sheet was given. Bankers finally said, now the enforcement director issued a notice to the banker also. You tell me, why are you not reconciled earlier, and now you are coming and saying the entire money was received. Whereas according to your digital thing compliance with the RBI, you said some 300 crores were due. Now the point is, we told them, look, whatever you are proceeding against the bank, as far as the company is concerned, under section 32 of the Evidence Act, transactions which are audited in the books of account is an admissible evidence. Go to the annual account. It's a listed company. We have to get it audited. We have to produce a non-compliant. There is a bad debt. There is a separate statement, debtors turnover ratio. We have given it to the banker. The board has approved it. Auditors have signed it. Director's report that is not mentioned. It's a serious amount. 300 crore will choke the working capital. And it is passed by the general meeting with so many independent directors. Unless you take the annual account is fudged under fraud, you cannot proceed against it. Rest is only procedural non-compliant. And with some difficulty, it was accepted. So there are other methods by which you can prove it was an extraordinary situation where the levy of penalty as much as 40-50 crore were avoided. So best evidence is to be produced. That's what I'm coming to. 42 is a very tricky section, because directors and officers, you have to prove either you did not attend the board meeting, you are absentee, or the whatever contravention has happened without your knowledge, or you are given the dissenting vote in spite of it, it has happened. Then LSF, I told you earlier, I gave you the practical example of private sector company, agricultural investment, investment in prohibited sector, permitted sector without approval, technical omission. Prohibited sector is a serious violation because you can't even cure it. So I will end the program with this. Maybe 4 minutes earlier I have ended it. Now I will go to the
So, there is one question. I just share my screen, and many were requesting for the recording of the session. 1 minute.
can a screen be shared now? I don't know.
Yes, yes.
I am not sharing the PowerPoint slide any longer.
Yeah, I am sharing the screen, sir. Is my screen visible?
Yes, now it is visible. Yeah. Is LSF applicable to form FCTRS? Bank did not forward the form, who will be responsible? See, normally LSF, I have not done any LSF because it is a digital filing. As lawyer, we have not been filing, whether physical or digital. I think FCTRS, LSF, because normally you are supposed to file FCTRS, if I remember correct, within 60 days of settlement. So FTI normally only for FTI and ECB LSF is available. ODA it is not available to my knowledge. I have to check. If it is not LSF, you can file it belatedly, go to Reserve Bank of India and compound it. See, you have something to worry when the amount involved is huge and the delay is several years. If it is few months, LSF is there. I think LSF is there for FCTRS. I have to check and get back to you. Because the digital filing have not been filed. If LSF is not there, you can go through compounding. It won't go to ED. Whether a CA can appear before you, why not? In fact, you are in the best position to advise certain matters, especially when it comes to export, because there is something like I found in two of the cases, major cases, I was able to address the ED not on the lawyer knowledge. In fact, the ED officer himself told me, you are using your chartered accountant knowledge so that we have not given a wrong order. You are so reasonable person. Your accounting knowledge has prevented the enforcement director from giving an incorrect order. Because I went to debtors turnover ratio, past 3-year analysis, annual accounts as an admissible evidence, director's board, all these things have got nothing to do with FEMA or any law. Especially in commercial matters and even arbitration. Chartered accountants can do a wonderful job because there is the legal involvement is limited. Commercial matter will be heavy. In case of LSF, the same is applicable for transaction after if I made a default in filing form FLA. LSF will not up to 2000 because LSF itself came for in November 2000, I think November 17, 2017. So up to that you have to go for compounding, and then after that you can apply for digital filing and LSF.
Those are the questions that came up, sir. We'll see 1 or 2 minutes if there is any. And many were requested for recordings, and the recordings will be shared to the registered participants over mail in 2-3 working days. To all registered participants. And also will be uploaded in SIRC website.
Any other question? Students, you are free to ask any other question on the connected matter.
Yes, sir. Please.
Are any more questions?
No, sir, we didn't see any question. Maybe it may take some time. If there is any, sir, we'll write it to your mail, sir. And I hope the PPT is having the mail ID of SIRC. So if there's any, they will be writing it up to you.
Oh, PPT doesn't have mail ID. What I can do is, I can, if there is any place where I can write, I can write.
Yes, sir. Okay. Okay.
Yes.
There's one question that came up here.
What are the rules for B2B cash and carry business by foreign company? The B2B cash and carry business is a wholesale trading. It is in compliance with law. There is a Delhi High Court. Cash and carry need not mean always. It is to be understood as per the Commerce Ministry directives in that. It's a wholesale business to business is wholesale trading permitted under the FDA rules. It is not retail. Next question. I hope it is clear. In case of imports, if the company does not make payment to its creditors within the time limit of FEMA, what are the legal reasons? This is very important question. Thanks for asking that. See, recently, one of the large corporate client of mine, the income tax authority on a faceless assessment, I said, you have made the delayed payment, therefore it is a trade credit, it's a violation of FEMA. What cannot be done directly, you can't do indirectly. Violation of FEMA is not an admissible payment. So I will disallow that. And we disallowed as much as 238 crores to impose a huge tax. So if you don't make payment to creditors within the time limit, what is the recourse? That depends upon your communication, because no seller abroad will keep quiet. Suppose, let's say, he sells you a machinery for 5 crores. You are supposed to pay him within 6 months. If you have not made payment, nobody will keep quiet. They will either threaten a litigation or ask you. There will be mail correspondence. Your contact is what is relevant. So if it is beyond 1 year, our bank got power. For every 6 months, there is an extension power to the bank. You can go to the bank, say there are some financial difficulties or quality issues, quantity, whatever. But if you are pandemic now, both imports and exports are getting affected in the last 2 years because of cash flow problem all over the world, not only in India. But if the question is, there are two things. I will follow me carefully the word. Are you unwilling to pay or unable to pay? Unwilling to pay means you have financial resources, but not willing to part with the money because of some quality issue, in which case you have to re-export the machinery, get the supplement corrected and then pay. Unable to pay, you are willing to pay. There are no quality issue, etc. But simply that you have a financial difficulty. Which one of the two? So contact and the communication is relevant. Up to 3 years, bankers can extend 6 months at a time for 6 times. Beyond that, it has to go to RBI for claims. Next question. Sir, I am a fresh chartered accountant. Please share your views on starting a FEMA operation. Please go ahead. In fact, if you are a fresh chartered accountant, you should continue to do whatever accounting you have, whatever audits you have, then FEMA practice, arbitration practice. Because arbitration is one matter, especially on commercial matters. Number of things depends upon agreement, value of shares, business issue, regrouping of business, dispute between corporate houses. These are best settled by chartered accountant or lawyer representing with the help of chartered accountant. So there was a case where there were 7 lawyers involved. I appeared and then they objected to my appearance because they say I am also a chartered accountant. Finally, with 1 or 2 hearings, the judge permitted me to arbitrator, was a retired judge, me to appear. There is only a technical. And then I was able to sort it out in the best interest of both sides by a settlement. Not because of my legal knowledge, but because of my chartered accountancy knowledge. So you can do most of it. And then the arbitration, it's not like a court proceeding. You have so many formalities, serpentine procedure. If there is an error also, you can correct. 1 or 2, you do it, you can form your own procedure. Good luck to you. If the foreign company wants to start B2C, are they allowed or any rules? Yes, B2C, there are a number of rules because earlier case, one company or person, B2B. B2B is business to business. B2C is business to consumers. That is a retail trade. You have single brand, multi-brand, sourcing condition, number of conditions are there. If you fulfill all the conditions are tabled in foreign investment policy, if you fulfill all those conditions, you can do. Up to 51% automatic approval, beyond 51% single brand government approval. You have all those details you can go through. Next question. Sir, came across the following sentence in the FDA policy. A manufacturer is permitted to sell its products manufactured in India through wholesale or retail, including through e-commerce without government approval. Notwithstanding the foreign investment policy provision on trading sector, 100% foreign investment under government approval is allowed for trading, including e-commerce investment of food product manufactured or produced. Does it mean B2C sale only wide government approval? Yeah, B2C you need government approval. Depends upon branding. It only what it wants to clarify is without manufacturing you will do only trading. That only is controlled by single brand and multi-brand. What here they are saying, you are manufacturer and you are also trading. After all the manufactured goods must be sold to somebody, either by wholesale or by retail or by digital method. E-commerce, marketplace or stocking place. There are 2 kinds of digital method. That only they are permitting. Pure trading is what is controlled by single brand because that is called trading. This is manufacture and trading. The emphasis is on manufacture. Trading, any manufacturer will have to do trading, otherwise how will he survive? Clear? Do a partnership firm need to file Form FLA? Every foreign investment will have to file Form FLA. I will give you a reference material. Foreign exchange management reporting guideline. Recently, it has come in 2019, where individual master direction reporting they have deleted, put everything in one place. Separately for FDI, for ODI, for ECB, for guarantee with forms, procedure, instruction for filing form, so on and so forth. There is no distinction for, see, partnership normally is done by NRI only. Foreign investors will not prefer a partnership. Normally, they prefer only a limited company. You have to fight. If it is on a repatriation basis. If it is on a non-repatriation basis, you need not file. Anyway, no filing is required for a non-repatriation basis because that will come under Schedule 4 of investment, where it is treated as a domestic investment, not as a foreign investment.
Yes, sir. Those are the questions. So Satish sir, over to you, sir.
Thank you, sir, for a detailed presentation, and very nicely you are talking very wide subject in a very small time within 1 hour. You shortcutted and given the practical aspects of the matters. And I think the people those who are around 92 persons are attended this program. And I think that persons may be keenly, as a young member, as correct and know the practice of the FEMA. Nowadays, all traditional practices are going less. So new areas has to be found out. Then I think FEMA is one of the area. So that everybody is get delighted with your all highly experienced version or subject matter and discussion on regarding the matter. I hope that everybody enjoyed the session and they got high knowledge or revised their knowledge or the practical aspects of the enforcement director issues. Thank you so much, sir, for your very short, within 1 hour, you are elaborately explained all practical aspects of the matter. Thank you very much for your all detailed explanations.
Thank you, sir. I would like to add only a couple of sentences with your permission for all my fellow chartered accountant learner members. That I don't know, most of you may be younger to me, or some of you may be even older to me in terms of experience and knowledge. The next 10 years is going to be very critical for India, and we are the overall structure within the nation, the macroeconomic indicators, and the electric vehicle and domestic manufacture of electronics with oils and defense equipments domestic manufacture. These are the roads which are being laid at a broad level. It is going to take India, for example, before COVID in November 2019, our forex balance was 420 billion. Today it is 630 billion. That has grown in the COVID period. And next 10 years with electric vehicles substituted, our dependency on defense import, oil import, electronic import, all the three are going to come down periodically in the next 10 years, where we will be a military might. World may need India than India needs the world. So best part of your career, you will see a more fit, stronger, mighty, a supreme power India. And we will be one of the three important forces in the community of 192 nations in the globe. And that way you will have lots of opportunity, particularly joint ventures, foreign collaboration, international arbitration, and forex related matter, including the current topic of adjudication. I hope we can all develop ourselves. I include myself. And best part of career belongs to you. In 6 dimensions, as my friend MB Authorey has said: physical fitness, intellectual depth, psychological maturity, aesthetic taste, material well-being, that is subjective, and spiritual awareness. So we will be exporting to rest of the world goods and services along with spirituality in the coming decades, where the century belongs to Asia. The next 10 years are critical for India. Especially one of the gentlemen was a young chartered accountant. I wish the young chartered accountant, all my fellow brethren, the best wishes, and thanks for a very pleasant hearing. I thank the institute and I thank Mr. Satish for kind words of introduction. Thank you very much.
Thank you, sir. Thank you, sir, for your very informative, ICAI is going to be the #1 leader in the economical world. That is very interesting thing. So let us hope that very younger members get more opportunity to the profession and do the things very well. Thank you.
Thank you, sir. Now,
Thank
with
you,
your permission, can I end the close the session?
Yes, sir.
Yes, sir. Sure.
Sir, we have next speaker Sridhar sir has joined the session, sir.
Okay.
Good evening, sir. Welcome, sir.
Sir, good evening.
Very good evening, sir.
Sir, directly we are going to start or any break is there, Sir?
No, sir. We'll start, sir, because since it's a fresh session, we'll start as such.
Okay. So we heard from our expert faculty Ramesh sir regarding the ED matters. Now our next speaker Sridhar sir is going to explain the practical issue in FEMA compliance and auditor's role. So I think the auditor's role is more important in FEMA because those who are doing the FEMA or those who are not doing the FEMA, they have to comply all the regulation even for a small company. As Ramesh sir told, if any director is bringing money as a capital or a loan, that also have a problem in FEMA. Sir, many of the members not actually even in I know in 15 CSEB issue, many of the members don't know what is the importance or the issues behind that 15 CSEB. Many I know when I'm taking international taxation classes in many forums, so I know that many of the members are not aware of the what is the behind that form 15 CSEB, whether it's income tax or FEMA. That is the methodology or the things we are having a problem. So I think with expert knowledge of Sridhar sir, they will know what is the auditor's role in the FEMA matters. With these few words, I am introducing our expert faculty for today. Sridhar sir is a company secretary and a lawyer by qualification. He has over 24 years post-qualification experience in the tax and regulatory matters. Sridhar is a tax partner in Grant Thornton LLP and is also responsible for transaction tax practice of the firm in South India. He is a regular speaker at forums across India, including the ICAI, ICSI, and various trade professional bodies, where he speaks on foreign direct investment policy, exchange control law, special economic zone, and income tax law. It has contributed to policy making on the special economic zone laws across state and central government agencies. He is the author of the book on exchange control law in India called FEMA Ready Reckoner with the commentary, published by Bloomsbury. And I know that he is going to explain in detail the auditor's role and the practical aspects of FEMA compliance. Within 1.5 hours, we can expect a very very exhaustive explanation, practical explanation from him. So I welcome sir for the technical section of the practical issues of FEMA. And thank you for accepting our invitation. And on behalf of all of the members present here, I welcome you to the function, to the program. Thank you.
Thank you very much, Satishan sir. Always a pleasure to be speaking to this August forum. And it's been some time since we got used to the virtual world, and this has been a very interesting way to kind of interact with colleagues and fellow members. This is hopefully some of it will rub off into possibilities of meeting in person as well. So I look forward to the olden days, as we call it, where we used to speak and interact in person, where the connect with the audience is much stronger than as compared to this. So without much ado, my previous learned speaker, Mr. Ramesh, is actually very authoritative in the subject matter itself, and therefore my burden of kind of taking you through some of the provisions as well as some of the practical issues that we are facing is therefore that much more lighter. What I have particularly focused is that as an auditor, what are the issues that you need to keep in mind when you are looking at a company's books and or an entity's books? And I'm also pointed out some of the practical issues that we have faced across companies. What's been prevalent and what the RBI looks at, how these need to be resolved. So there are multiple ways a problem can be resolved in exchange control law as well. And when you slice the problem into multiple transactions, each of the transactions have to be kind of measured from an exchange control perspective. So it's a very different perspective as compared to a pure accounting perspective as well. And I'll take you through some of those examples when we look at it in detail. So without much ado, if I was to break this session into two parts, what we have done in the next slide, I have kind of captured the index on what we want to cover, essentially practical issues as well as the auditor's perspective. So if I was to look at how law is worded, so this is an interesting law. It's typically a significantly delegated legislation. So what I mean when I say that is because while there is exchange control law through the Foreign Exchange Management Act, the law is delegated through a set of regulations and rules. And as you know, it's further delegated through implementation at the authorized dealer and the Reserve Bank of India level. So the regulators are themselves banks as well as Reserve Bank of India finally. So there is a lot of oversight, particularly in cross-border transactions, and therefore any transaction that a resident interacts with a non-resident has an element of exchange control law that you must bear in mind. And at the cost of repetition, I'd like to say that there are broadly two categories of transactions that the exchange control law defines itself into. The first set is current account transactions, and the second set is capital account transactions. And by definition, the term can be not so clearly aligned to how accounting looks at it. So a purchase of capital goods in itself is a current account transaction, but when you purchase it with a liability which stands over time, which means you've purchased it on loan basis, that makes it a capital account transaction. So the definition of a capital account transaction is important for us to understand. And what it really means is a transaction which affects the asset or liability position of a resident outside India, or the asset or liability position of a non-resident in India. So in traditional parlance, even opening a bank account therefore is an asset, or holding stock in India or overseas by a resident, holding stock by a resident outside the country in itself is also a capital account transaction by that definition. And that's why the line blurring this in traditional accounting terms is distinct from how RBI looks at it or exchange control law looks at it. And current account transaction obviously includes within its ambit anything other than capital account transactions. So by definition, capital account transactions also by default include setting up offices abroad by residents or foreign investment into the country by non-residents, immovable property acquisition by residents overseas or by non-residents in India, uh, external commercial borrowings, which are traditionally loans, investments and or facilities that non-resident Indians can avail. in terms of acquisition of real estate and or properties and bank accounts, and also the blurring of line when liberalized remittance scheme that was introduced by Reserve Bank of India also talks of what is possible under current and capital account transactions overall. So as a principle, everything that is other than capital account is treated as current account, and therefore the first test that you need to apply as an auditor is to test whether this transaction is a capital account transaction or a current account transaction. So for instance, if a person is buying equipment from a foreign supplier, and that payment is being made on an immediate basis, it is actually an import and therefore current account in settlement. Whereas if the person is buying the capital goods or on a deferred payment basis, on lease basis, therefore he creates a liability in favor of a non-resident to pay such non-resident over time. That's when the transaction becomes a capital account transaction. So in itself, the import of any kind of goods, whether capital or raw materials, all of it gets covered in the definition of a current account transaction. The same applies for movement of people as well. So when a person is seconded to say US, and an Indian company is making a payment for his salary, by definition, the secondment in itself is to an office overseas, and that in itself is also by definition a current account transaction. But when you start opening branches or offices abroad, that in itself also creates a capital account transaction implication. So what the branch does, so for example, you must also read it in context of what is a resident, who is a resident. So interestingly, the branch of a foreign company in India is treated as a resident, whereas the parent company, which is the foreign company itself, is treated as a non-resident. So the transactions between the head office and the branch in India are also by implication a transaction between a resident and a non-resident, and therefore it's important that although it's within the same legal entity, each of those transactions have to be tested for whether they are current account or capital account. The same, by same inference, if an Indian company was setting up a branch abroad, the setting up of that branch in itself is seen as if it's a current account transaction, and RBI has permitted some of it to go through because it's essentially opening a bank account abroad, and some of it is permitted under the automatic route. But what the branch does is really what creates a capital account or a current account transaction implication, because the branch of an Indian company abroad is also treated as a resident. So if an Indian company sets up a branch in UK, the branch in UK is an extension of the Indian company and is treated as a resident for exchange control purposes, and is measured for what it does in UK. So for example, in UK, if that branch buys immovable property, that is a capital account transaction of the resident. And similarly, if the branch buys other property, again, that is an activity which creates a capital account or a current account transaction implication in itself. And therefore, it's important. The first thing that you must do as an auditor of a company which is transacting with non-residents is to measure the nature of transactions that are happening between the Indian entity and any non-resident, whether it is individual or associations or corporates or even other forms of businesses. So all of that gets measured in the terms of whether it's capital account or current account. And once you've defined what is capital account, that's when you start measuring it in consequences, because current account transactions in themselves are generally free, subject to reasonable restrictions, whereas capital account transactions are all subject to specific approvals of the Reserve Bank of India. Uh, Now, having spent some time on this, I'd like you to kind of see some of the specific issues that we've seen and how RBI looks at it from a practical perspective. Now, there are multiple answers possible, and that's the good part about exchange control law. FEMA is a law of intention, and therefore when you go to a regulator, the form of what you have done is generally looked through, and the intention of why you did that is much more significant in how a regulator looks at it, as if it is a significant non-compliance or is it just a procedural lapse. And each of that will have a consequence in terms of how compounding or how offenses are resolved under exchange control law. So for example, in this example, what I have tried to say is that if a foreign company sets up a new company in India, and it funds the Indian company for reimbursement of expenses that have been incurred. So PQ Inc. could have incurred certain initial expenses in setting up R Limited itself. So the question is that how do you treat this under exchange control law from an accounting perspective, as well as from the perspective of how the regulator will look at it. So there are three possibilities that you could consider. The first one is to say that these are preliminary and pre-incorporation expenses, and those can be converted into equity share capital. That's the first option. The second option is that if this company was anyway going to export goods or services from India to overseas, can that remittance into India be considered as an advance for exports? And the third is that can PQ in India, the remittance from PQ Inc. be treated as a loan in itself? So all three possibilities exist, and each of them have their own consequences when when the regulator looks at it. So for example, in this situation, if you were to go with option one of issuing shares against these remittances, the sectoral cap and the FDI policy is the core consideration basis which you can actually do this. And obviously, when you are allotting equity shares, there's a time limit within which you must allot the equity shares, without which this will be seen as a default in terms of missing a timeline for issue of these shares. The reporting in itself of the actual allotment must be done within 30 days, and that's done through now online, in an online mechanism through the single master form and the subsequent FCGPR form in itself. And valuation has to be followed as a methodology. Again, while we as auditors have different hats, and if you are an auditor of the company, you may not be able to undertake valuation from an independence perspective, but valuation in itself requires a chartered accountant to certify that that the value of this company shares is appropriate and is based on an internationally accepted methodology. That in itself is a certification with chartered accountants end up doing. And therefore, in option one, these are the elements that you need to bear in mind as an auditor or as a chartered accountant when you look at it from this perspective. The second one is much more straightforward in terms of routing the money as an advance for exports. Obviously, exports, the expectation is that the actual export must be undertaken within a 9-month period, and this has been during COVID time, it has been extended to 15 months, but essentially 9 months is the time period within which you must certainly settle the advance. And there can be an extension of up to 6 more months with the approval of a AD banker to be able to export the goods or services that are underlying the advance. So this is a very simplistic method of funding an Indian company for some of the preliminary expenses that may have been incurred. But the interesting part that you must bear in mind is that when a pre-incorporation expense is incurred, the company in itself is not in existence. And therefore, what is happening is that the foreign company may have paid some of these monies directly to vendors or to regulators. For example, the ROC fee may have got directly paid or paid through a consultant who set up the company in India, and then there is a reimbursement that the company is expecting. So therefore, when a pre-incorporation expense is charged to the Indian company, and if it has been borne by the non-resident, what is the nature of that expense is important. So for example, some of the practical issues that we have seen is so when a non-resident, when the company is not formed, and when an office rent is negotiated, the deposit for that office sometimes comes through from the non-resident directly. And once the company is formed, the ongoing rent is then paid by the Indian company. In such situation, the deposit in itself becomes a liability that is shown by the Indian company to be paid to the foreign company. And there again, the issue is this: when you pass the entry itself, it creates an impact in exchange control, which means that it's not necessarily an issue that has to be measured at the time of remittance or at the time of payment, but it's an issue when you pass the book entry itself on whether it is permitted or not. And therefore, as an auditor or as an accountant advising the company, you need to be aware of how exchange control law treats this entry in itself. And again, you measure this to be a current account or a capital account transaction per se. So a deposit in itself, when charged to the Indian company, creates a loan or a liability to pay from the Indian company. That in itself becomes a capital account transaction. And because it's been done prior to incorporation, normally the practice is to go back to Reserve Bank of India for a specific permission. Thankfully, RBI has generally permitted such preliminary expenses to be capitalized. So that's when option one takes you over, and up to 5% of the total project investment that you're planning, or up to $100,000, you could very well charge that expense into the company as capital. That's again going through option one in example, but option two in effect will mean that there will be a distinct advance that will come in separately, and then there will be a distinct reimbursement that will be paid back. So there, what it means is you'll need to flow the money on a circular basis to repay the amount that is shown as a payable. But by nature, you can always argue that it's a current account reimbursement, because some of the preliminary expenses in themselves could be reimbursements to consultants for having done incorporation work, or for having paid registrar of companies the ROC fees. All of that is current account transactions, and the reimbursement in themselves is also therefore treated in the nature of a current account transaction. So that's option 2 for you. So we have jumped from option 1, which was a capital account transaction, into option 2, which is purely current account. And option 3 is obviously to treat this as a loan, which means that you must meet the conditionalities that are prescribed for the loan in itself. And therefore, some of the key points that you must keep in mind, again, as an auditor or as a chartered accountant, is that there is an expectation to certify on a monthly basis the drawdown of that loan, which needs professional support. There is also an expectation, a lot of companies go back to compounding just because they haven't taken the loan registration number uh, prior to drawing down the loan. So it's such a simple thing that you must not draw down the loan before getting the loan registration number, or the UIN number as it is called now, which makes it a non-compliant drawdown, which makes it a compoundable offense. And there's been significant cases on compounding of such delays on account of not having taken the LRN but having had to draw down the loan. So simple things which you could manage while doing the compliance at the right point in time can lead to consequences of compounding. Again, I'm sure my previous speaker may have spoken about it, but compounding in itself is broken out into procedural lapses and material lapses. So if you don't fit in to the exchange control policy, for example, if you've drawn down a loan which does not qualify under any of the preconditions for end use or for maturity or for interest payments, all of that then becomes material non-compliances. Whereas having not taken a loan registration number and missed that is a reporting non-compliance, which is treated in a very different manner. And therefore, any compliance that you miss can be condoned in a different manner, whereas anything that is material in your intent takes you into a very difficult situation with the Reserve Bank of India. So in this example, each of these options can lead to non-compliances. And when we look at this from a non-compliance perspective, if uh, if you have missed the deadline of 60 days for issuing the shares, you must go back to Reserve Bank of India for obtaining approval for capitalizing the shares. And only on receipt of such approval can you allot the shares, again at fair value. So there is always a requirement again to go and adhere to the compliances mentioned above. Again, having delayed the allotment of shares because you went for an RBI permission, you are not absolved from going through the compounding process in itself, and therefore the compounding of delay in allotment of shares and delay in reporting in the single master file form are distinct matters which need to be compounded with the Reserve Bank of India, and you must admit it. So the guilt, exchange control, at least FEMA in India, must necessarily measure you for your intent. So if you had intentionally not disclosed something, RBI can take a very difficult view on it. Whereas if you admit an offense and say that there are operational reasons for non-compliance, obviously the penalty is a fixed amount. And for example, in this example, we have seen compounding fees levied at 0.03% of the amount that was contravened. in option 2, it's all current account transaction unless there are some deposits involved or unless there are some complicated underlying transactions involved. So a pure reimbursement for having spent preliminary expenses is something which is pretty much straightforward and does not need any approval from any authority. So we've bracketed the transaction into what is defined as current account transaction. So if you miss again on the ECB side, again, you'll need to go through the condonation process. You need to go to RBI to file form ECB for obtaining the loan registration number along with condoning the delay. Once you get the loan registration number, you need to go for compounding of the offense. And for ECBs, there is a late submission fee which has been prescribed under the compounding rules, and therefore these are specified amounts depending on the value of the contravention, and therefore much more simplified as compared to what the previous positions were in this matter. Prior to 2016, RBI was running a discretionary basis for compounding such offenses. So now, if I move to the next example, we've taken an example where a foreign company has two forms of offices in India. One is a branch office and the other is a project office. And it is possible for the same foreign company to have both the branch office and the project office together, running together. And each of them is treated as a distinct office for the purposes of exchange control law. Whereas for the purposes of income tax and for the purposes of Companies Act, these are clubbed together. So you have a very interesting situation here where the PAN number is common for both the project office and the branch office. You can have a distinct TAN number for both offices depending on what you need to do. And the ROC reporting from an accounting perspective and the ROC registration of the entity in itself is one common entity. So your accounts are therefore consolidated in this example. But the project office for RBI purposes is a distinct person as compared to the branch office that this company is running. Now, in this example, what we wanted to say is that ABC was incorporated, has a branch office under the RBI approval, and it also had a project office for the purposes of undertaking a Government of India project. Now, when the project office was getting closed, the assets and liabilities of the project office was transferred to the branch office, and that's really where we need to take a view on what happens in exchange control law. So in this situation, what happens is that foreign exchange management establishment in India of branch or office or other place of business regulations specify that you must you can remit any surplus that the project has made on its completion on submission of documents. It is therefore expected that the project office is paid for the asset and liabilities, and that is separately remitted as if it is a surplus of the project, whereas the branch continues with the approval of the Reserve Bank of India. And therefore, the transfer of the surplus assets and liabilities from the project office to the branch office in itself needs an RBI permission. And in this case, in our example, the annual activity certification of the branch, which the auditor also has to cross certify, was not submitted. So therefore, there were multiple non-compliances. So what would you do? You would first submit the annual activity certificate for allowing the closure and this has to be submitted till the point of closure. So this is not necessarily the year end submission, but also say, so if you suppose closed the branch, suppose you closed the project office on 30th of September, in and move the assets as of that date into the branch office, the annual activity certificate of that project office has to be filed separately till 30th September. And thereafter, the branch anyway has to file its own ongoing compliances with the Reserve Bank of India through the authorized dealer. So first is to come up to speed on your annual activity certification. Then is the actual intimation of RBI for closure, including the procedural lapse of not taking the RBI permission for transferring the surplus assets and liabilities to the branch, which RBI would usually give a permission on, and then condone the delay on account of non-submission of the document. So the process in itself is pretty painful, and therefore it's important for you to track this. Why I brought this up as an example is that a lot of people miss this because this is the same legal entity, and when you have multiple forms of branch and project offices running together, it's always a challenge for you to monitor this closely, because the understanding generally is these are fungible money and or assets because they are sitting in the same legal entity. That is not the case, and each of the bank accounts as well as employees and assets and liabilities have to be tagged separately for each of these offices for their life of their existence. Now, this is pretty normal, and while I've taken an example of an employee being seconded, but we've seen a lot of issues around debit notes and intercompany payables. So let me exemplify this in what we are trying to say here. Essentially, ABC PLC was a company which had a branch office in India, and which also had another branch in Singapore, which ABC PLC also had an investment into an Indian company through a joint venture. So the structure was that PLC had a branch in India. It had a company in Singapore which had a 49% investment in another company in India, and ABC itself was also owning another company in UK called XYZ. So XYZ was given the role of seconding a specialist into the Indian joint venture, which is X Limited in this example. So that was the first step, that XYZ seconded an individual to X Limited, an Indian company. Now, for that secondment, the XYZ company actually raised a debit note for the salary that it paid for that employee uh, to ABCBO, the branch office. So it did not charge this money directly to X Limited, but it charged this to the branch office of ABC PLC in India. And the branch office then made this payment from India to UK. And this was traditionally, this is a current account transaction. And therefore, if ABC branch office was to remit this money, what would happen is you would need a 15 CA and a 15 CV, and you would also need to prove that this remittance can be made under current account rules. And like we mentioned, the process of making the remittance in itself requires certification from the chartered accountants in themselves, or in some cases the statutory auditors as well. But because these are current account transactions, the remittance was actually made in this example. But now here is where the interesting part comes in, that ABC Asia Singapore also raised a debit note on X Limited for making this payment, and therefore X Limited also made a payment to ABC Asia Limited. So in a sense, for the same secondment of the same individual, the branch office as well as X Limited ended up paying one to XYZ UK Limited and the other to ABC Asia Singapore Limited. And because these are current account transactions, the onus on making sure that these are genuine payments falls on X Limited as well as ABC BO Limited. Now, having realized this mistake of having charged this twice over, XYZ Limited actually credited ABC PLC UK in their intercompany accounts. So you have another non-compliance which is having credited a non-resident for a payment which the resident, that is the branch, had made. So if you see from a non-compliance perspective, this is a very complicated non-compliance from an RBI perspective. So what do you do in these situations? Obviously, the auditor was the first to spot this, and this is where your intervention comes into play. When you see the any kind of debit note or any kind of charge coming through, it is up to you to take a view on whether that is current account or capital account, and on what is the supporting documentation here. So obviously X Limited uh, paying to ABC Asia was justified because the employee was sitting in X Limited and doing that job. But ABC branch office, the auditor of the ABC branch office, is the one who's missed the point that the person was not necessarily working in the branch, but he was actually deputed into X Limited while performing his role. And that's where the auditor was able to kind of identify that the entire sum that ABC was charged needs to be refunded back to ABC branch office, and therefore XYZ Limited was supposed to remit this back to India. And this is where exchange control law again gets into the complexity of an expectation that actual cash settlement has to happen through a remittance into the country. There is no way you can settle this through an accounting entry. And that's why this becomes much more complex for unraveling. And therefore, what measures were taken in this example? We went to RBI to first seek a clarification whether the branch had contravened any provisions or not. So so there's always the good intention to even seek RBI's clarification, which helps in these matters. RBI usually is not open to providing clarifications directly to companies, but your authorized dealer bank is enabled to ask for these clarifications, and there is a process through which RBI answers your authorized dealer bank. They do not entertain direct conversations with customers usually. And having gone with a clarification, it was understood that the actual transaction still constitutes a current account transaction and is undertaken in the normal course of business. So therefore, the severity of the transaction non-compliance comes down because it's a current account transaction in itself. And therefore, RBI's response in this example was that actually the issue was that if the branch had approached the bank, its AD category 1 bank, to open an account, and credit of such account represents funds received from the head office, a debit of such expense incurred by the branch is also permitted. Therefore, it was compounded on the basis that RBI can regularize the contravention of the BO. And while filing this application, it was clarified that the annual activity certificate non-filing was a procedural lapse, but a compounding fee was levied equivalent to 0.1% of the amount of contravention. So, so even a current account transaction in itself needs to be addressed fully to be able to be on the right side of the provisions of exchange control law. And book entries are really the issue that we wanted to highlight here for you to assess as an auditor. The next example is where an Indian company has gone ahead to undertake multiple investments abroad. And the last of it was a project. So we've taken one example, but these are multiple non-compliances that were done in across multiple entities, and therefore needed to be contravened individually. So for example, the Indian company setting up a wholly owned subsidiary in Dubai, while this was permitted under automatic route, the form ODI was filed after making the remittance, and therefore that in itself was treated as a non-compliance. So while in law you have 30 days to file form ODI, form A1 or form A2 that you file in the first instance is when this conversation on filing for overseas direct investment and the non-compliance thereof comes in. Obviously, the investment was done prior to obtaining the unique identification number, and that was the non-compliance that was detected. And only after obtaining the UIN can foreign investments, foreign remittances be done. But these were also not duly reported to the authorized dealer banker. And there was further complication that the classification of the remittance was also not properly disclosed of whether it was a loan or share capital. So each of these, in the way form ODI is filled in and how the auditor certifies this, is very important. So for example, there is a controversy today on what constitutes the net worth for the purposes of overseas direct investments, and this is required to be certified by auditors. Interestingly, the definition of net worth for exchange control for ODI purposes does not include share premium account, and therefore the overall net worth of the company for overseas investment purposes is limited to paid up capital and free reserves only. And if you were to exceed the 400% ceiling in this example, you are expected to go back to RBI for a specific permission. A lot of people miss this, and therefore it's on the auditors to identify and point this out for clarity purposes. In the second line, when you see the US company, you will notice that this is a joint venture. Again, the direct investment in the joint venture was also made with a delay in the filing of form ODI, and there was loan and corporate guarantees that were extended to the US company which were not reported in the ODI. A lot of people miss this, where they feel that corporate guarantees in themselves do not constitute a liability, so it does not fall in your balance sheet, but it is a guarantee that is that can be invoked, and for exchange control purposes it's treated as if it is a liability in itself. So just merely giving a guarantee at the point of giving the guarantee itself is a capital account transaction, and without RBI's permission, general or specific, a resident cannot give a guarantee to a non-resident, whether it is for goods or services or performance or for a capital account transaction like an investment. And therefore this is something that you need to bear in mind when you look at it. Of course, there have been general permissions that are granted by Reserve Bank of India for such guarantees, but you need to be within the limits for such transactions. Obviously, there was also a delay in submission of proof of the investment to the bankers, and that in itself was also a contravention. Now, if we look at the Netherlands company side, again, Form ODI Part 1 was not filed for the purposes of corporate guarantees that were issued. That in itself was a non-compliance. There was payment of interest that was paid on invocation of the corporate guarantee. That also was missed. And the Form ODI was not filed at all for reduction in the amount of guarantee on account of the invocation of the guarantee itself. So again, multiple non-compliances, particularly on account of guarantee, which created non-compliances. In in the last set, there has been also contraventions on account of issue of performance guarantees for project offices. So if an Indian company has a project office through which it is doing project exports, the issue of performance guarantees for performing of certain obligations which could be current account in themselves is also a capital account transaction and is seen as a contravention if the performance guarantee is not backed by an approval of the authorized dealer. And therefore, what the project office does in itself is the example that I wanted to bring to your attention. That if in this example, what had happened was the project office in Belgium had gone ahead and given a guarantee as a project office for supply of certain equipment, and that guarantee was invoked, and that in itself, the provision of the guarantee itself was seen as a capital account transaction because it was a resident, that is the project office being treated as a resident, which was subject to exchange control law in India. And when it got invoked, it certainly created a liability on account of the resident paying for such guarantee to a non-resident. Essentially, compliance around overseas direct investments is something which is very significant for an auditor to review from time to time. And as you all know, all investments of an Indian entity is subject to the limit of 400% of its net worth, and therefore it's not just one investment that you need to look at. You need to look at all of the investments, and this is a continuous obligation. So which means every year you need to measure this at that point in time and then go back to RBI if there was a non-compliance. The UIN has to be generated for each investment separately, and this is something a lot of companies fail to do and end up going through a compounding process. Again, annual filings are necessary, both at the time of setting up, ongoing the APR form as we call it, as well as the form that is ODI 3 or ODI form part 4 for closure of the joint venture or wholly owned subsidiary. So a lot of compliance that you must bear in mind has a direct bearing on how auditors certify this, because this is a direct certification from the auditors. And from a project office perspective, what the project office does overseas is significantly important. And therefore, for example, there are forms, form PEX or DPX, which are specifically directed towards project export rules, and therefore supply of contracts on deferred payment or turnkey civil construction contracts abroad, or where contracts involve grant of fund-based or non-fund-based facilities from an Indian bank, or where there are deferred payment terms. All of these need to be reported in Form PEX or DPX to the authorized dealer banker or to Exim Bank, depending on who your banker is. Again, guarantees in themselves for performance need to be issued only after approval of your AD banker. And on completion of the project, it is important that all the surplus from that project is repatriated back into India. While the word used is immediate, usually you get a 1 month's time to do this, but how you retain the money abroad can be seen as a significant non-compliance if you were to do that. Therefore, closing the bank account and closing the project in itself are important steps that you need to undertake while you are looking at a project office abroad. I will skip this for the reason that these were non-compliances that were levied. Just suffice to say that compounding fee was levied, but very nominal on account of non-compliance. Now, this again was a very interesting issue on identifying what is the nature of the transaction, and when multiple parties are involved, what happens. So this is our own example where GT was appointed as a trustee of Mr. A, and Mr. A was essentially a bankrupt person. So on account of bankruptcy rules of UK, GT was appointed as a trustee of this person. And when a person steps in the event of a bankruptcy as a trustee, whatever A had to receive from anybody anywhere in the world becomes morally obligated for the trustees to recover, because only then can the bankruptcy proceeding be settled. So in this example, what had happened was Mr. A had advanced about $2.8 million pounds to a UK company, and that UK company had further advanced the same sum to an Indian company, which was developing an Indian hotel. So the UK company's advance to Indian company was in the nature of an ECB, which proceeds were used to develop a hotel in India by the Indian company. Now, on account of the bankruptcy of Mr. A, the courts in the UK held that the 2.8 million that is beneficially owned by the GT UK partners in their capacity as trustee of Mr. A was due from the Indian company directly, because the UK company had further given this further down as a loan into the Indian company. And when the Indian company entered into a settlement, the trustee was able to claim this money from the ICO 2 in this example. So what happened was the Indian company also went into a settlement agreement, by virtue of which Indian company took over the advance that UK company had given to develop the Indian hotel. But the Indian company too also showed a liability on account of this loan, not to the UK company but directly to A. So through a settlement mechanism, the trustees, which is GT UK, was able to release the claim on the property on receipt of the consideration from ICO 2. So essentially, an ECB that got shifted from ICO to ICO 2 in the time of a settlement, and the ECB proceeds were then used to not settle the UK company, but directly Mr. A on account of the insolvency proceedings. So therefore, multiple angles of non-compliance that came through. So what would happen in this situation is, obviously you would need an RBI approval for making the remittance of the settlement payment from ICO 2 to the to GT UK. And the point in contention was that it needed to be explained that that the RBI remittance represents a repayment of an existing liability of ICO, which was transferred on account of the settlement to ICO 2, and therefore it was in the normal course of business in itself, and therefore you needed an RBI permission, which was granted. So so going to RBI with your hands clean is an important step for remedial action in such situations, because if you don't go to RBI and try to structure the transaction in a way which seems to be permitted, your intention will always carry a color, and therefore that will become something that will be very difficult for you to explain. So always, when in doubt, your advice as an auditor or your advice as an accountant to such entities should be to go to RBI for a permission, and then honestly explain the reason. So RBI would be a reasonable authority to hear your explanation, and if you approach this in the right manner, RBI would usually grant permissions on such sensitive matters also. So apart from this, you would see a lot of ongoing practical issues that you would see. So for example, a lot of people miss this point that there is an expectation to settle exports and imports in reasonable periods of time. And while these look like current account transactions, any non-compliance and any behavioral lapses lead to the the regulator coming in heavily, because then the intention is questioned and not necessarily the transaction in itself. So for example, with RBI coming out with the IPDMS and the EPDMS portals, it is very important for you as accountants to look at the back end of that transaction as well. So what may not reflect in your accounts of the company would be the one-to-one matching that an IPDMS portal or an EPDMS portal uh, will show up. So some of the imports may not have got cancelled, and therefore they may be still showing as payable in the RBI portal, which could result in a non-compliance, while in the accounting it may be coming in as an ongoing transaction, and therefore it may not get visible to you in a current account. So if there is a regular import that is happening, it's very difficult for you to monitor this as an auditor. But what you must ask for is, what is the IPDMS portal showing, for you to be able to match what is showing as a payable on account of imports to what the RBI's portal is showing as what is actually due. So that's when it will show up in your audit as well, and the same thing for exports as well. So these are practical issues that you must keep in mind when you look at these transactions from an auditor's perspective. And like I said, an import transaction which does not get settled in a 6 month or at best a 12-month period, and if it is kept open for more than 3 years, your intention gets questioned, and then by intention it seems like it is a loan, because you've not paid for an import and you seem to have got excessive credit period in itself. So in itself, it looks like you have got a credit, and that again goes by behavior. So like Ramesh said in my previous conversation, that how you behave will matter in whether you were able to make the remittance because of your ability to settle it, or you did not want to make the payment because there was a litigation, or you did not intend to pay it. So that's where that intention will again matter in settling these advances, settling these payments. The same thing for exports. Of course, it's a bit more liberal in terms of write-off of dues, as long as it is a reasonable limit of 10% within the same year, and anything more than 10% goes to the AD banker. But you still need to make sure the export EPDMS portal of your AD banker is matching to what is your actual export receivable showing. Have you knocked it off against each of the export invoices that have been received? So it's an invoice level match, and it's an invoice level match against an actual export that you may have done. So it's pretty tedious, but you must make sure as an auditor that you look at the back end around this. And anything that is non-compliant or requires a write-off or extension of time again goes back to RBI or to the AD banker for approvals. So at this point, I've kind of covered what practical issues that we have faced around challenges that we have seen on the ground. At this point, I'd like to also bring out the auditor's perspective, and I only have one slide, and then we can kind of go through this in conversation. So if you see, there are 4 brackets that we have kind of put in on what would you look at from an auditor's perspective. And I've spent some time on this from a current account perspective. Uh, so book entries in themselves are something that you must verify, especially when a non-resident is being paid for some services or for goods. If it is for services, what is the nature of services that he has performed becomes very important, and is it a genuine payment is the most important thing that you must bear in mind. What is the nature of services that he has provided, if it is an individual or a corporate, or is it merely a charge of a reimbursement? So what exactly has happened is something you need to go to the bottom of. Verify the IPDMS portal or the EPDMS portal, as the case may be, for any mismatches. These can be significant, and significant consequences can come on account of mismatches here, because at the worst, these matters get reported to the enforcement directorate directly, and even highly governed companies miss this compliance in terms of making sure that the IPDMS portal or the EPDMS portal is fully up to date. And the difficult part is this portal is not in your control. It is accessed by the authorized dealer only. So you don't have full visibility on what that portal says against your name, but you must ask your authorized dealer banker to fully transparently match this on an ongoing basis, and it's an obligation for the authorized dealer banker to do this. Now, if you are an SEZ, if your customer is an SEZ unit, or if it has claimed EXIM policy benefits or customs law benefit for import of goods duty free on account of some advanced licenses, etc., the obligation under exchange control law is much more severe. Has the company received foreign exchange in convertible foreign currency is an important element for you to match for purposes of NFE, for example, in SEZ rules. And what is the process that is being followed to match obligations that are defined under EXIM policy for imports duty free, or what you get on account of customs incentives on duty drawbacks, etc. So all of these are important elements that you need to measure from an auditor's perspective, and then decide whether the transaction is above board and proper in terms of compliance. Again, on the capital account side, much more regulated environment under exchange control law, and therefore any investment into the country must be compliant with the FEMA non-debt rules, and must be compliant of the FDI policy in itself. Downstream investments particularly require auditors to comply with a certification which must be reported distinctly to say that the downstream investment is in accordance with the FEMA non-debt rules and or the FDI policy. A lot of companies miss this compliance, and when we look at downstream investments, the rule on what constitutes a downstream investment is also important to know, that any investment by a non-resident or a set of non-residents which goes beyond 50%, that is 51 or more, 50 or more, 50 plus 1 or more, makes this a foreign owned Indian company, and therefore these are governed by similar rules as would apply to foreign direct investment. So any such Indian company which is predominantly foreign owned, if that company was to invest further downstream, that is in itself also treated as foreign investment, and rules around pricing, rules around foreign direct investment policy on sectoral caps or sectoral restrictions and conditionalities, all of these apply. Similar rules apply for investments into LLPs as well, and therefore you as an auditor are expected to make sure that the FDI policy in itself is complied with by the Indian company when such an investment comes through. ECB compliances also take a lot of effort in ensuring compliances, and you as an auditor are expected to make sure you look at how end use has been factored in, how hedging has been done on such borrowings, how drawdown has been defined, and how your payments in respect of each of the remittances is verified in terms of how it has been used, how interest is capped, how much is paid, how much is your all-in cost, etc. All of these are important elements for you to measure. And again, like I spoke on outbound investments as well, those are also capital account transactions, and those in themselves also need a lot of attention from auditors. Then there is a set of certification in itself. So when you look at certifications in themselves, all certifications for foreign direct investments or overseas investments, valuation, and ECBs in themselves need a lot of attention from auditors and or chartered accountants, and therefore each of these you need to be very cautious in issuing such certifications. Especially valuations now also have a income tax element, capturing how value is assessed for income tax purposes, and therefore it's a very delicate balance on how you see this. There are rules on indirect transfer as well, which have kicked in on account of foreign companies which own significant businesses in India transferring their investments overseas, and therefore there is a valuation expectation at that level as well. And finally, I would say last but not the least is on how you approach compounding as as an issue in itself, and how you resolve your differences or non-compliances under exchange control law. Essentially, how you as an auditor also see it from a purpose of disclosure and or from a purpose of qualification. So is it an emphasis of matter, or are you going to fully qualify this in itself, are also dependent on how companies intentions and the management's intentions are, and therefore you may need to disregard the form of a particular transaction to measure the intention to be able to appropriately qualify or disclose such non-compliances as well. So with that, I broadly kind of come to the end of my session, and I'm happy to kind of take you into the next session, which is just Q&A and or answer any of your specific questions.
Sure, sir. 1 minute, sir. I'll just compile the questions and I'll display it to you, sir. 1 minute. Is my screen visible, sir?
Yes, sir.
No, very much, so you can take it.
Yeah. So the question, I would think the question is in case of company billing a cost plus method. That's the question, right?
Yes, sir. Yes, sir. From here.
Yeah. So in case of a company billing at cost plus method, assuming a 15% margin, how would the company finance the purchase of fixed assets in the initial level of operations? So the logical way to look at this is either an ECB or an advance or capital through equity injection. So these are the three methods that are possible for you to consider financing the initial purchase of fixed assets. As you know, ECB is not possible for purchasing land. Therefore, any land acquisition that this Indian company needs to do at the initial level of operations must be funded through equity only. And that's one basis which you need to also measure. Now, when you take an ECB, obviously you will charge interest, and transfer pricing will play out there itself. And therefore, this is a circular reference on how you would charge interest and how would it impact the 15% margin, and whether you can keep an advance model. So an advance which is settled in a 9-month export model to be able to finance the purchase of the fixed asset. So that's really how you would kind of come to this answer. But the transfer pricing margin in itself will shift depending on how you finance the purchase of the fixed assets. The next question is NAV FMV method, which is considered for income tax 56-10, an internationally accepted methodology for FEMA purposes. Unfortunately, the NAV method is used only when the company has no significant business or if it has significant assets only. So while the NAV method in itself is an internationally accepted methodology, it is not a preferred accepted methodology when it comes to FEMA's understanding. And you would usually use this only when this company is not doing any business but only owns assets, which means it's only you owning land and building or something like that. which is usually not the case. So 56 to 10, you can consider only in a very limited basis. And 56 to 10 also is very different. It's not pure NAV. There are other things also that play out in NAV. So the next question is, share application money received from NRO account of NRI needs permission. So an NRO investment, so an NRI investing through an NRO account is treated as a resident investment. There's no reporting or oversight of Reserve Bank of India. The only key point being that an exit. So when the NRI sells the investment, again the money cannot go abroad. It has to be given only to the NRO account in India of that non-resident Indian. So nothing is repatriable. So these are by definition non-repatriable investments, and non-repatriable NRI investments are treated at par with resident investments. Can an individual who has made ODI through LRS transfer the shares in ODI to another resident? Should the consideration be paid through foreign currency account by the transferee? So there are specific guidance under the ODI rules for transfer of ODI investments that are reported as ODI to be transferred to another resident under the ODI mechanism. But if it is through the LRS method, that's a different window. So you cannot mix the windows. And if that is the case, you need to go to RBI for a permission. The consideration can be paid in rupees if this is ODI reported on both sides. If it is not, if it is one of it is LRS, then you cannot, you will go to RBI for a specific permission to do this. So I am not able to see the next question. How to check EPDMS portal? Yes. So EPDMS portal is completely on your banker, sir. You have to keep pounding your banker on giving you a download of the exact listing of the EPDMS portal up to date. So you must do this, as if you are a company, you must do this on an ongoing basis with your through your relationship manager, who is obligated to give you an update on the EPDMS portal. And any mismatches must be immediately highlighted, sir. Do not delay this, because this is a behavioral issue. What is the quantum of penalty that RBI normally levies on compounding or delay on import remittances beyond 3 years? Sir, again, intention matters here, but if it is not intended to be delayed, RBI can even waive a compounding cost, but usually this is between 0.01% to 1%. That would be the normal levy for delay in import remittances beyond. Again, intention will play out, but there is a range of such a nature. Is there any RBI reporting about trade advances received? So in prudence, you must let your AD banker know at the point when the advance is received on what is the nature of that amount. Because if the trade advance is to be settled through an export, then the EPDMS portal will mismatch unless you show that the advance is being settled first. So you are under obligation to tell your AD banker on the nature of the advance when you have received it. When an entity does not make an import remittance within the prescribed commercial dispute, so here you must immediately let your AD banker know that there is a commercial dispute because of which import remittance is not being made. And you must keep highlighting to your authorized dealer banker the nature of the dispute from time to time. So ideally in a 6-month period. So if it's immediately on arising of the dispute, you must immediately write to your AD banker and explain that there is a dispute. Immediately on resolution of the dispute, you must let the AD banker know, because uh, there could be demurrages as well, which are in itself capital account transactions. So it may not come under the purview of a current account transaction for remittance. So therefore, your intention of reporting this immediately is important. And from time to time, you must keep your authorized dealer banker informed of the progress or of the dispute in itself, so that they are fully aware of this from time to time.
Those were the questions. Questions about it.
Thank you, sir, for a detailed analysis of the practical issue of FEMA compliance and auditors role. As you said, many of the cases we are not aware of the things when we look into that matter. It's very simple, but we go on to the intricacies of the each sections or rules, then we can understand that how much complicated that issue may be. On the face of the matter may be very simple, but we will look into the matter inside. There are so many complicated problems. So I hope that members have enlightened with so many good practical experience by you. So I hope everyone learned there or renewed their or they call refreshed their knowledge in the auditors regarding the FEMA practical issues. Thank you so much for a very nice presentation. And on behalf of myself and SIRC, thank once again all the participants and the faculties for your all wonder speaking and the presence of your depth knowledge before the benefits of the members. Thank you so much, and good night to all of you. Thank you.
Thank you.
Thank you so much.